Hi, everybody. I'm so excited that you decided to join us today for setting your business up for permanent profitability. This has had such an impact on my business and on the businesses of my clients. I'm just thrilled with how Profit First has unveiled itself and improved the financial strength of my business and the story my business is telling. I'm going to tell you today about where I came from. I was in business for myself just for a couple of years. I started in 2007 and I was very good at sales. So I was easily able to pick up a staff of 5. And by 2013, I was running a very good bookkeeping practice with 5 employees plus myself. It was a good time in business in that I was able to sell. It was a bad time in business in that I was exhausted, overwhelmed. Like I said, I was very good at sales, but managing the money in the business was difficult for me. I could never figure out why there wasn't enough money. And I would run from one squirrel to the next squirrel, one good idea to the next idea, never quite understanding how it all came together to feed my profitability. So there was a little bit of codependency going on in my business. I was dependent upon my business to identify with myself and feel strong about who I am. And as a result of that, I felt very, anxious, terrified. I went to run payroll one day in 2013, and I realized there's absolutely no money to pay for myself. So I skipped paying for myself, which unfortunately wasn't an unusual occurrence in my business. I then went ahead and paid my employees. I was short by $34 and change. So my account overdrafted, and subsequently I got some more overdrafts. And I thought, this is horrible. I got to do something about this. I got to make some improvements here. So what I did, sadly, is not introduce Profit First at that time. I had not yet heard about it, but I went and got myself a business partner. And a business partner, if you're not in it for that key pieces that you're bringing to the business, is not a good choice. Okay. I brought this woman into the business solely for the cash contribution that she was able to add to the business, not because we got along terribly well. And while she was a lovely lady, it didn't work out because we didn't have the same ideas about how to go to market. And a business partnership is a marriage of sorts. So that marriage did not last very long. We divorced within a year. And that's when I realized I just cannot do this anymore. I was so exhausted that I left the business at the time and went back to just being a solo entrepreneur. So I did okay as a solo entrepreneur. I started to make some money. I had connections. I'd been doing all these years of every networking meeting, every 8 a.m. breakfast, and every 5 p.m. cocktail hour. And I had made a lot of connections. That part of it was very strong in my business. So what happened is when I went back to being a solo entrepreneur, my business organically grew. And I was doing great. I was doing as much business as one person possibly could, but I knew that if I wanted to scale up, I was going to have to hire some additional help. But I was still enjoying it. So this was going on for about 2 years. The business partnership broke up in 2014 for about 2 years. I worked solo, and in 2016, in the fall of 2016, I was really excited to realize I had enough money to attend this fabulous business conference. I was so excited to go to the business conference because it was at the Atlantis in the Bahamas. And when I got to the Bahamas, of course, it was a gorgeous location. Of course, the speakers were fantastic. I heard this guy, Mike Michalowicz, speak about profit first, and it set me on fire. I was like, this is the missing puzzle piece that I never could put my arms around. So I was thrilled. I went home, I joined the Profit First Professionals group, I became certified, and by the end of 2016, early 2017, I had fully implemented Profit First into my business. And again, it was life changing because every dollar had a purpose and a place and a job. And so I finally knew without doubt how I could grow my profitability and still maintain my sanity. It was a big deal. So I'm going to tell you about the secrets that I learned in hopes that you can apply them to your own business. So the thing that we know in Profit First, or that the Small Business Administration of the United States has let us know, is that they have surveyed businesses that have revenues of 25 million and under in annual sales. And what they found out when they surveyed those businesses is that 83% of them are living check to check, collection to collection. And only 17% of small businesses under 25 million in annual revenues are able to be profitable and continue past one session of invoices and collections. So what does that actually mean? What does it mean to survive check to check? Well, it means that you're always waiting for your client to pay before you can pay your own bills. It means that you might not have enough money in the bank to cover your payroll like I didn't have. I was short by $34, right? It means that you might choose to not pay yourself in lieu of paying somebody else on the staff. It means that you're probably going to be stuck with a bunch of bank overdraft fees. What a waste of money. Poor borrowing choices. You could be stuck with high interest credit cards because you're not able to secure a nice line of credit at a low and decent rate. And it means stress and anxiety and a loss of sleep every day that your business goes on like that. So what I'm going to talk to you today about is implementing Profit First in your business and becoming one of the 17 percenters in business that are able to move past the survival of check to check living, okay? And grow and prosper in profitability. So in Profit First, we have a saying, you'll see it at the bottom of the screen here, sales minus profit equals expenses. And this is an oxymoron as it relates to generally accepted accounting principles. Most people say that the equation in accounting is sales, that's your total revenue, less your expenses, less the money you spend is going to equal your profit, okay? However, in Profit First, we're reversing that equation. We're saying that you still have your sales on top, we're gonna then pay ourselves next. We're going to take the profit out so that we know that we're taken care of and we're feeling financially secure. And with what's left, we are able to pay our expenses. Sometimes that means we have to cut back on our expenses in efforts to make our business profitable. So that's what we're talking about today. There's 4 main principles of Profit First. They all are very similar to someone who would be on a diet and trying to take off a few pounds. So we call them small plates, eat your veggies first, avoid temptations, and last, stick with the exercise and frequency and counting those calories. So we're going to use those same concepts from dieting and applying them to our small businesses. So let's get to it. The first concept is the concept of portion control through small plates. What we're saying in Profit First is that every dollar in your business that's collected has a purpose and a place, and we need to save room for each one of those. So we divide up the money that comes into the business into smaller portions, okay? And we do that through the use of bank accounts, right? So portion control in a small business looks something like this. We're setting up these multiple bank accounts. we set up 5. The income is the first one. All of the income from our business comes into one bank account. That's your serving tray, okay? It has all the different food groups on that serving tray. Then from the income account, we divide the portions of our business into the ways we're going to spend the money. So we have total income. We can't spend more than we have received. And then underneath it, we set up a bank account for profit. We set up a bank account for owner's pay. Owner's pay is paying ourselves. It's putting food on the table. It's putting a roof over our heads. It's putting shoes on our feet. It is not for taking fancy vacations to the Bahamas to go to the Atlantis. It's for the basics. It's for the things that we live with, okay? Profit is for taking vacations to the Bahamas, okay? Then there's 2 other accounts, tax. If we are profitable, there will be a tax burden. And that's another way that we as owners can be prepared and financially savvy in our business, is being prepared for tax day, knowing and understanding that because you've made the right choices in your business, you're going to have some level of taxability, and you're prepared to do that. So it's no surprise. The last way that we spend money is through operating expenses. So operating expenses are those things like paying for your sales and marketing efforts, putting paper in your printer, having a printer, having office space, rental space. Those kind of things are our operating expenses. If we have any staff or administrative assistants, that goes into operating expenses. So these are the different portions that we divide our money into: profit, owner's pay, tax, and operating expenses. So the serving tray of income has to provide for those 4 different portions. There's another one that we're not mentioning here that I want to bring up, and that's the difference between total income and real revenue. Real revenue and total revenue are 2 different calculations in our business. So if I am a dog walker and I collect $10,000 in dog walking fees, I need to pay my dog walkers. I wasn't able to pay each of those dog walkers myself, or to walk each of those dogs myself. That would have been a lot of dogs to walk. So I hired other people and I said, I'm paying you 20 bucks per walk. I'm paying you 10 bucks per walk. Whatever it is, that amount that I paid to the dog walkers is my materials and contractors expense. And my business has not made any money until the materials and contractors expenses are paid for. Okay, so we have this total revenue coming in. That's all the money collected from walking dogs. Then we have to pay out to our dog walkers for the amount of walks that they have contributed. Then what's remaining is called the real revenue. The real revenue is what we're going to use to fund those other accounts that we just got done talking about. So again, those accounts were profit, owner's pay, taxes, and operational expenses. With this real revenue number, we are now splitting it into those 4 different ways, 4 different purposes of spending money in our business, okay? The next lesson in Profit First is to eat your veggies first. Again, going back to that dieting concept, if we want to lose weight faster, we have to make sure we intake more vegetables. Okay, so in Profit First, what that means is that we're going to be allocating. We're going to take that income account, the total revenue collected, and we're going to subdivide it into these other accounts. We're going to say, okay, materials and contractors, or my dog walkers, they get 50% of my take. So I have to subtract the 50% first. So if I had $10,000 collected and I paid the dog walkers $5,000, then I have $5,000 of real revenue. And I'm going to take that $5,000 of real revenue to divide it into those 4 categories that we talked about. I'm going to put some in profit, put some in owner's pay. I'm going to put some in taxes. And last, I'm going to put some in operating expenses. We have percentages for this in Profit First. We call them target allocation percentages. And basically what Mike has done is he's surveyed and done a lot of behind the scenes work to figure out ideally how profitable you can be based on your real revenue range. So if you don't know what the industry standards in your industry are, which you may be able to find them out from a trade association in your industry, what most people are paying for operating expenses and how much most owners are able to pay themselves and what their tax rate is, you would be able to find that out from an industry expert. If you do not have that information at your fingertips, it is absolutely acceptable to use these target allocation percentages that I have up on the screen because they are very deeply researched and we know that these are very accurate. So I'm going to give you an example of a creative services firm that's providing web design and web development. This particular firm had $600,000 in revenue in 2020, and they came to that $600,000 in revenue via the support of 5 team members. So on their team was the owner, and the owner also had an office manager who managed the jobs. The office manager was an employee of the business and was paid $50,000 annual salary per year. And then on top of that, the business had 3 web programmers and designers. And those folks were subcontractors. They're not employees of the business. They're subcontractors, and they have been employed specifically for delivering web design and web programming to the clients of the firm. Those 3 web designers are each making $70,000 each. So 3 times $70,000, $210,000 is how much they took of the $600,000 of total revenue in the business. So based on that, I want to pick out which target allocation percentage column I should use and apply that to how I think this business could be profitable at $600,000 in total revenue. So this is what we know about the business. We had total revenue of $600,000. We paid 3 web programmers and designers $70,000 each. So that totaled out to $210,000 over the course of the year. So those folks are going to be our materials and contractors expense. We would not be able to have collected that $600,000 had they not done the web design and the web programming for the clients. So $600,000 minus $210,000 of materials and contractors is going to equal a real revenue available to this firm of $390,000. Okay, so now we know that this business has $390,000 with which to go out and spend money. Okay, and from there we can say, okay, $390,000. They fit in this target allocations, they fit in column B. They have $390,000 of real revenue. I see on this chart that if a business has between $250,000 and $500,000 of revenue, then these are the percentages, ideal percentages with which that business should be running in an ideal situation. So let's just do the math on this. Of the $390,000 available, then we want 10% to go to profit. So that's $39,000, right? That would be transferred over the course of the year to a profit account. Owner's pay, again, that owner's pay is what we use to put food on our table and shoes on our feet. Those are our everyday expenses that we need to feel comfortable and safe. That percentage is 35. And 35% of 390,000 is equal to 136,500. So that's a decent living. Most people can make $136,500 work in their lives. They can get their basic needs and taken care of with that amount of money. So that's what we're saying they would be able to pay their own bills with. Okay, now tax, we want this business to be profitable, right? We're hoping at the end of the day that there's at least $39,000 in profitability in the firm. We think we need to reserve about 15% of that for tax. And 15% of it would be the tax paid against the $136,500 that has been paid to the owner, in addition to the $39,000 of profitability that is included in the firm. Okay, so 15% of $390,000 is equal to $58,500. So what we want to do is set aside $58,500, which is the 15% of our real revenue of $390,000, to go over to the tax account. And if our real revenue is $390,000, the very last thing that we're doing is we're paying operating expenses with it. So with a real revenue of $390,000, we can spend 40% of it on operating expenses. 40% of 390 is $156,000. So $156,000 is what we're going to be used to pay for the rental space for our business, the paper, like we talked about, the pens on the desk, the sales and marketing efforts, our own web design to represent our business. All of those things come out of operating expenses. So before we move forward on this, I want to go back through the 5 employees in the business, or the 5 participants in the business, the team members. Okay, so first we mentioned the owner, right? The owner is paid through 35% of real revenue. And that here in this situation, in this $600,000 business, ends up being $136,500. So the owner gets paid that. We have 3 subcontractors in this business. They're each being paid an annual salary of $70,000 per year. They came out before we even got to our real revenue number. So those folks were paid under the materials and contractors. So you had total revenue less the materials and contractors is equal to the real revenue. Okay, so that's how we went from 600,000 less 210,000 for three contractors at 70,000 each is equal to 390,000 of real revenue. The last person that I mentioned that is a stakeholder in this business is the office manager, and the office manager has a employee salary of 50,000. That employee salary is going to come out of the operating expenses. So remember, we had $156,000 with which to pay for our operating expenses. The office manager would have been a part of that $156,000. So that's how the money all worked out throughout the year 2020. Okay, we're trying to hit each of these targets. The third rule in Profit First that we have to keep track of is to remove temptation. So again, going back to our dieting perspective, if we take out the things that we shouldn't be spending money on and remove the temptation, it's much harder to spend money on them. So if we don't keep cookies and candy and chips in our house, it's a lot harder to eat them. It means that we have to get up and drive to the store and buy them before we can eat them. So we're applying that same concept of removing temptation to our small business. And to do this, we're setting up a separate account for profit, and we're setting up a separate account for taxes, and we're funneling money over to those two accounts. We have removed the temptation because we're all subject to being creatures of habit. And most often what we're going to see is, whew, I have $20,000 in the bank. I totally have enough money to spend this $5,000 widget that I want to buy. Okay. And the truth of it is that $5,000 might be spoken for. There might be a reason that that 5,000 is there and you've forgotten about it. Maybe you have your mobile phone automatically drafting from your OpEx account. If you spend that money, is there going to be enough to pay for the mobile phone expense that is optionally coming out of your account automatically? Okay, so we want to remove the temptation by setting up extra bank accounts and funneling money into them so that we can spend them when needed. Because the truth is, we don't spend money on taxes every day. We spend money on taxes a couple times a year. You might be subject to quarterly estimates. You might have them taken out of your payroll. You might have an end of the year tax bill when your tax preparer prepares your taxes. Okay, so we don't have to pay that as often as every day. And we want to remove the temptation of spending it on something else. So we're going to put that money in a different bank account. We can even put it in a different bank. So making an inconvenient bank is another strategy to keep that money whole. So if you know that you're one of those people that's guilty of grabbing the bag of chips that's in your cabinet and sitting down on the couch and watching Netflix, then maybe it's a good idea to not buy the chips. And by that, I mean, maybe it's a good idea to have that tax account set up at a bank across town, so that if you decide that you want to enroll in this new coaching program, you're going to have to go get the money from that bank, move it over to this bank, and then you can spend it. In the process of that, what we're hoping happens is you rethink it. Do I really need this dang coaching program, or is it really just more than I can afford? Okay, that's what we're hoping to achieve. So the fourth and final rule of implementing profit first in your business very well is to focus on frequency. All right. So there is complex things that happen once a quarter, like doing a profit distribution and reallocating and calculating your target allocations. And there are simple things that happen when you're using profit first in your business, which is twice a month, you want to transfer money from that income account where everything's been collected into these other bank accounts. Okay, so frequency in the dieting explanation is showing up and doing your exercise, right? Part of a dieting equation is making sure that you're exercising regularly, not just once a month. You have to go for that run or get on that treadmill every day, right? And the other part of that is counting calories. If you want to lose weight, you have to be at a calorie deficit, right? So we have to do that every day, not one day a week. We're probably not going to lose weight if we only do it one day a week. So in our businesses, there are things that we are going to do on set frequency levels to make profit first work better. And when we implement on set frequency levels, the result is that the money builds up on its own without us having to think it through, right? And there's always going to be money to pay the bills. We know how we're going to pay those bills because we're going to be paying them from the right accounts, right? The money is going to be coming out of the right accounts. And the other thing that's going to happen is we have formed a habit, a repeatable habit. So we don't have to go and think through it every time. What's my percentage? You know, how much money do I have? If we're able to pull up our bank accounts on our phone and take a look at the balances, we're going to be able to see those balances building. And we're going to know that that phone bill, that mobile phone bill is covered because the money is already in the bank. So the 10th and the 25th rule is the frequency that most people choose to do their target allocation transfers, sometimes called target allocation percentages, sometimes called current allocation percentages. We're doing that about twice a month on around the 10th of the month and the 25th of the month. And the reason we choose that is because that's kind of the way life works, right? We usually look at the bills we have to pay in our personal lives around twice a month. And once is, kind of at the beginning of the month, and once is towards the end of the month. So we set a rule up that we are going to look at our financials twice a month on the 10th and the 25th, and we are going to enforce that rhythm. So the money has built up in our income account. It comes to the 10th of the month. We're going to transfer the money out of the income account. So the value in the income account is 0, big fat 0. And we're going to put it into these other accounts. Then we're going to spend from those other accounts accordingly. We're going to let the money in the income account build up. And then around the 25th of the month, we're going to repeat that rhythm and do it all again. Okay? So this can be a little bit terrifying for some, because they might be thinking like, shoot, I haven't paid myself in 3 months. I haven't paid myself in 6 months. I'm living on fumes. This is a scary thing to think about. I mean, if we go back to that chart, and I think I will go back just so we can look at it. The business owner that has a real revenue range of $0 to $250,000 should be paying themselves 50% of every dollar brought into the business. So that means that if you have $250,000 of real revenue, that you should be paying yourself $125,000. That can be a little bit terrifying, because most people who have $250,000 in revenue coming in don't necessarily have 125 of it being paid to themselves. Okay. And so how do I get from A to B? Well, we've kind of already covered that answer. You get from A to B by keeping up with the frequency. And I just have to say, you are smart enough to make this happen, and you just have to set the fears aside and go to it. You're good enough. You're smart enough, and doggone it, people like you and you deserve it. So do it. Go ahead and get these different bank accounts set up and get your profit first percentages set up. And you may not be at 50% of every dollar of real revenue going towards your own bank account today, but one step at a time, one allocation at a time, one day at a time, eventually you will be. So the next step, the big step that you can do today to get profit first going in your business, is to get your butt to the bank, okay? And declare your profitability now, today. This is about permanent profitability. So even if you don't have enough money, say your business is operating at a loss today, Angie, can I start profit first today, even though I'm operating at a loss? You absolutely can. Okay, what you do is you get your butt to the bank, you open up that very first important profit account, and you start taking 1% of every dollar of real revenue and funneling it to this profit account. And 1% is not going to make a hill of beans difference in your business, but it's going to make a big mountain of difference in your mindset, because you have declared yourself permanently profitable. And that 1% is going to grow, and you're going to say, gosh, I wish I could do 2%. I wish I could do 10%. And you're going to find ways to cut out the fluff in your business and earn more money towards your bottom dollar. Okay? So the first step in implementing profit first is to get your butt to the bank. You're going to open up an income account, a profit account, an owner's pay account, a tax account, and an OPEX account. Then you're going to drive your butt across town to an inconvenient bank, and you're going to open up 2 more accounts, your profit save and your tax save, okay? And you're going to have all your accounts set up, and you're going to start funneling that 1% into the profit account and claim your place in permanent profitability. Ooh. Hold on. There we go. Okay, so always remember that sales minus profit is equal to expenses. we take the profit out first. What's left can be spent on expenses. So in Profit First, we focus on what comes first. What comes first is setting up those different bank accounts and starting to funnel your money by percentage into those different bank accounts. There is a rule of thumb that we follow. It's called Parkinson's Law, and it is our friend. And it becomes clear and evident when you're implementing Profit First in your business that our demand expands to meet the supply. So if you think about it in terms of a tube of toothpaste, when you get that fresh tube of toothpaste out of your medicine cabinet and you go to brush your teeth in the morning, you really slather on the toothpaste onto that toothbrush and you brush your teeth. Over time, the amount of toothpaste in the tube keeps decreasing until the end when you just have a little bit left. And instead of tossing that tube of toothpaste into the garbage, what you do is you work your hardest to squeeze out that last little bit and put it on your toothbrush and brush your teeth. And so my question back to you would be, are your teeth cleaner because there was less toothpaste or more toothpaste, or didn't it really matter? You kind of got the job done either way. So at the beginning, when there was lots of toothpaste there on your toothbrush, you still brushed your teeth for the same amount of time and moved on with your day. So what we're saying is that if you take your profit first, we're going to squeeze everything we can out of that tube of toothpaste and make sure that the rest of our business is taken care of, right? We're going to make sure that the important things are covered, that the important expenses are covered, and we're going to get rid of the fluffy expenses. Because every time we get rid of a fluffy expense, it means that there's more in the bank to pay ourselves. Okay, so this really does end up being bank balance accounting now works, right? Because before, when we only had one account and everything was getting dumped into that one account, right? All income, all expenses, all materials and contractors, all tax payments were all being paid from this one operational account. What happens is that we pulled it up on our phone and we looked at our checking balance, and we had the opportunity to work with a vendor that we were really excited about. And as a result, we're really excited and we look at that bank account balance on our phone and we say, totally, we can afford this. There's money in the bank. But you forgot, I also have to pay my taxes from that money. I have to pay my operations expenses from that money. I have to pay my contractors from that money. You know what? There's nothing left to pay this fabulous new vendor. So now that we have these multiple accounts, we can see that that principle is going to work in our favor. The way it works in our favor is that we see those balances and we know without a doubt if we can afford said vendor or not. We know that that money is either there or it's not. Okay, so now the bank balance is dictating the expense. Okay, deposit dictates the expense. And we are leveraging our habits instead of fighting our habits, trying to remember in our head what is scheduled to come out of one bank account with a lot of transactions moving in and out is very difficult. But if we have multiple accounts and we can see the bank balances and know that this particular account is going to be used for this particular expense, it's very easy to leverage that behavior. So repetition is key to Profit First. We talked about frequency and habit, and doing something over and over. The more you do it, the more it becomes a habit, and eventually we have changed our mindset. So just because we may not be at the percentages we wish to be at today doesn't mean that with time and sticking with it that we're not going to be at the percentages we wish to be at in the future. So I'm suggesting that we lower the bar, okay? And just stick with the rhythm and keep doing it. Keep working towards that habit of profitability. And again, we're doing that by declaring our profitability and opening that profit account and starting to funnel 1% of every income deposit into that account. So it's confidence, building confidence, to building competence, to building cash. I'm going to tell you some great numbers from my own business. I told you earlier that I started this Profit First in my own business in late 2016, early 2017. I was totally struggling with profitability, which I've admitted. Now I've been doing it for 4 years. 4 years later, my revenue, total revenue, is only up by about 10 to 15%. That is not a ton of total revenue to be increased by. However, I am paying myself as the owner of my business 63% more than I was 4 years ago. So I have taken pay raise after pay raise after pay raise. And the number that's really amazing is that my profitability in my firm has increased by 340%. So while I've only increased my total income by about 13%, I have increased profitability by 340%. So I know that this stuff works, and I'm so excited for you to be able to implement it in your own business. It's powerful. Okay, so we have some different ways that you can take advantage of next steps and getting this going in your own business. The first is this free instant profit assessment. And I believe Kitty's going to be putting it up in the chat, as well as you're going to be getting an email after with a recording of this video, along with the link to that instant profit assessment. So this is another free opportunity for my listeners so that you can go and click on that instant profit assessment, get to work calculating your own numbers, and then you can set up a time to meet with me one-on-one for 20 minutes and go over those calculations and see if you feel comfortable with them. Okay? The other way that you can get in contact with us or work with us more is through our group coaching. We have a program that's called Startup Solutions and Profit First Coaching. So we're implementing Profit First in a group setting. It's a 10-week course, and we meet every week for an hour and 15 minutes to marry those concepts of good accounting principles and compliance with that of good financial management and bringing profitability to your firm. So it's really fun stuff, and I encourage you to take a look at that group coaching opportunity. It's specifically for businesses that are in their first 3 years of business, are trying to be profitable and get things set up. They don't yet have enough money to hire a bookkeeper, so they're trying to manage their own QuickBooks file, and they need to understand how QuickBooks works, and we're giving them some tools and tricks as far as how QuickBooks works. And then on top of it, we're getting that profit assessment done, we're getting those bank accounts set up, and we're declaring permanent profitability in our business. So those are the tools that are going to be available through that group coaching. And the place that you can start, again, is through the instant profit assessment and booking a 20-minute review with me directly to take a look at your numbers and see how things are going in your situation. So that is the end of our presentation today. Again, Again, Kitty is putting that stuff up in the chat for you to take a look at. And she'll put my contact information up there as well, but you can certainly find us on the web. We're at reconciledsolutions.net. I'm on Facebook at Reconciled Solutions, and I'm at LinkedIn under Angie Knoll, okay? And what's gonna happen, Cliff, is that even if you were joining late, we're going to be sending you a link to the email. We'll put it on our YouTube, or a link to this presentation. We'll put it on our YouTube channel. You can listen to it at that time. It will also have the links to the group coaching. It will also have the free instant assessment link. You can get signed up through all of that stuff through there. I'm very happy that you were able to join us today. Thank you.
Thanks.
Angie,
Right.
I understand there was some problems with Zoom, so a few people had a hard time getting in. My daughter told me too, with school, that at about 1:05, everything went down. So maybe that was the issue we were having.
Okay. All right. Well, everybody that was signed up for the webinar will be receiving those links, and those will be emailed. So no worries if you were able to listen to it live, or if you struggled to get with the Zoom link. There's just we're in Elmhurst, Illinois, and there's just a ton of snow on our roofs today. Both myself and Kitty are having ice dams and leaks in our house right now. So it may have impacted the internet. All right. Thank you, everyone. And here's to permanent profitability.
Thank you. Bye-bye.